Good morning, everybody. It is Friday, February 5th, 2021, and I am 50 years old, 353 days, 54 days, almost 51. So this weekend on Super Bowl Sunday, I'll be watching the Packers playing the Super Bowl on my birthday. Wait. No, they screwed up last week, and I'm not going to be watching the Packers playing the Super Bowl on my birthday. Well, I guess that's one thing that we'll get off the bucket list. All right. So a couple of weeks ago, I talked about how Wisconsin hasn't had a big blizzard or a snowy period or any 0-degree temperatures. Well, the state of Wisconsin for last week has been very upset with me because they said I put that in the universe, and now we have received over a foot of snow. And it's going to have a wind chill below zero today and single digits in the real temperature if you don't believe in wind chills because it's political or something. Just like to say, I apologize to Wisconsin and to the rest of the upper Midwest that is going through this weather. And I hear that the East Coast is about to get walloped as well, or is already going to get walloped. So hunker down this weekend. Watch Tom Brady and his 10th Super Bowl. I don't know. After a while, even I get tired of reruns. We'll see what happens. My big prediction for the Super Bowl is that Kansas City wins by over 20 points. So eat your snacks in the first half and then watch the commercials in the second half because I hear there's going to be about 4 this year. And yeah, there you go. That's your weekend. Stay warm. Enjoy a Super Bowl blowout and try to figure out something else to do in the second half. In any case, what are we going to talk about today? So I mentioned something that I read every weekend called the Tree Rings Report, and I'm going to show you a couple things in there. We're going to talk about liquidity in the markets and how it's slowly getting back to normal and what the impact on that could be. I'm going to talk about 2 stocks, not something I normally do, but it is a preview, at least partially a preview to the Monday stock show, which is members only. So if you're not a member, sign up for a free trial at Margin of Safety Investing, or go to Fundamental Trends, sign up for something more than the free library card. Free library card will generally pop up if you're not logged in. All you have to do is click it and you can sign up for a free library card. Pretty easy. Doesn't cost you anything. Gets you access to my Macro Monday article, monthly Fundamental Trends Outlook, which I'll put out this weekend, quarterly special reports, which I'm working on 2 right now, and we'll finish up with one of those today and present it next Friday, and then a lot of archived investment research. So at a minimum, get yourself a free library card, and I must already have it set to work here, but I have browser notifications, so you can sign up for browser notifications. It'll pop up in your window when you first get in here. You might have to check your permissions for the website to see what you're doing with notifications. This is Edge. Chrome looks essentially similar. You'll get a browser notification every time I send out an article, including the trade alerts. Now, some of the articles you won't be able to log into unless you're a member, but you'll at least get the alerts and get a hint at what we're doing. And then a lot of the free content that you just saw, you'll have access to this as long as you have the free library card. All right, so what are we going to talk about today? Well, the first thing we're going to talk about today is this. This is something that I get every weekend. This is very similar to that Bear Traps report that I get, which you can't get anymore. But this is a summary, a macro summary of things that are important out there in the markets. I don't agree with Luke on everything. He looks at things from a different economic perspective than I do. However, a lot of times you end up in the same place. You take a different road, but you end up at the same destination. And I think that he and I get to those similar places pretty frequently. And one of the things that he talked about last Saturday is that the Fed and other central banks are tightening U.S. dollar liquidity. What does that mean? Well, what it means is that we are likely to see less speculation in the stock market starting in coming months because it's going to be a little bit harder to get the cheap money to do it. The thing that's been pushing the stock markets up for months and months and months now that has really kind of blown me away has been the ability of small investors to get their hands on margin liquidity because the margin requirements are generally pretty low at this point. And then they're bidding up stocks using call options. As soon as that liquidity dries up a little bit, some of these rallies that you've been seeing where it's just money coming from everywhere is going to go away. And I've showed you the chart that tracks the Fed balance sheet with the S&P 500 before. We don't really expect the Fed to stop their purchases this year at all. However, as a percentage of market cap, it's changing. So one of the things to keep an eye on, the way the Fed was putting money into the market weakened the dollar, right? That's the takeaway. At this point, the Fed's not going to be buying as much of the U.S. Treasury issuance, and that will strengthen the dollar. So what we're going to see is probably a tightening up of credit, and probably we're going to see that it's not going to be as easy for speculators to speculate. We just saw with this whole Reddit thing, the people pushing GameStop up. The key takeaway there is that there was a huge short interest. The shorts were forced to buy shares. And then as the short interest dropped, and now it's gone back up again, it looks like, the Redditors were able to push the stock up. Well, the traders had become strong, right? You remember me saying that trading, small traders were becoming stronger over a long period of time because of the illiquid market. And then the market became liquid, and now they had a ton of money, so they became even stronger with that, right? So from a thinly traded market to a ton of money getting pushed into the market, it's just from one end, it's a pendulum going from one end to the other. What you are about to see now is that if the dollar liquidity and the easy money, the cheap money, becomes marginally less, right? Everything's at the margins. It's not that money's going to become tight. It's not that we're not going to still have loose money. It'll just be less loose. So the impact at the margins could be amplified. Well, if the Fed isn't as buying as many of the U.S. Treasuries based on issuance, then we're going to have to figure out what does that mean for the dollar. As I told you 4 or 5 months ago, I expected that if Biden won, Joe Biden became president, that would mark an effective bottom in the dollar for a while. And what have we seen? We have seen that the dollar has jitterbugged along that chart that I've showed you on multiple occasions. And we can pull it up real quick here if we want to pull it up. We have our currency charts. Pull out a monthly to condense it a bit. Here's your dollar right there. So as the dollar was coming down, Joe Biden wins and the dollar stops declining. Now, is that going to continue? Based on the way the percentage of the treasuries that the Fed's going to be buying going forward, you're probably going to see the dollar at least jitterbug here for a while, but it could rise substantially, particularly if the economy gets stronger. So if the economy gets stronger starting this summer, we saw unemployment numbers today that were underwhelming. They were on target. There really wasn't much of an addition of jobs. We know that the vaccines are, getting out there, but not as fast as we'd like them to, mainly not because the government's really doing anything wrong anymore. They've really pushed out what they could. There's just a shortage of vaccine, which is what we talked about months and months ago, is that there wasn't going to magically be 300 million people able to get vaccinated. We'll be lucky to get 100 to 150 million people vaccinated this year. And the children, if we can get them vaccinated for the start of the school year and get into the 200 millions for vaccinations by September, I would find that remarkable. And that would probably be extremely good for the outlook of the economy in 2022. One of the forecasts I just saw was that the economy would rebound to 2019 levels by this summer, and they were playing on words there. they're saying the growth rate's going to be up there, but the absolute spending in GDP is not going to be the same until 2022. So, pick your narratives and parse out what they're actually saying, because the headlines and the sound bites, aren't always what they're talking about 4 or 5 or 6 paragraphs in or in the follow-up article. In any case, if the dollar gets stronger here because liquidity gets just a little tighter, right, because the Fed's not buying as much of a percentage of the treasuries, and we see this dollar start to go up. And let's suppose that the Treasury Department and the SEC decide that all these Robinhood investors who have really no sophistication, I mean, they're using a platform like Robinhood, for Christ's sake, that has made investing into a game. They use a term called gamification. What happens to the stock market if it's a little harder to get money into it? What if the rules get a little bit tighter? You probably are going to see some of these broad rallies go much heavier into rotation mode. And I think we're already starting to see that. So while we haven't seen a big correction, and maybe we don't, maybe we get another 2015-16 period where the market chops sideways. And I think you should be prepared for this, because you may not get the one big correction that you're hoping for. You might have to work a little harder to get your money invested, which is why I've sent out some buy alerts lately. My outlook isn't that the world is suddenly better, but there's enough money out there already that even if liquidity dries up a little bit, it doesn't mean there's necessarily a crash, but it could just mean that, hey, S&P 500 is between 3,000-ish and 4,000-ish for a couple of years, rotates in and out of different sectors, different industries, winners and losers in industries and sectors, so that you're going to have to pick out what you really want to be invested in. And it's going to become more and more important that you really try to find companies that are going to succeed and outperform the indexes. As we've talked about, there are a lot of okay companies, right? There are companies that'll stay in business, they'll pay their bills, they'll pay their employees, but they're not really going to create a ton of cash for shareholders. So while the market is super liquid and pushing everything up, they look pretty good. But when the market has to start to choose between winners and losers rather than just bidding everything up as if it's a game, then it changes and your risk rises. Because if you want to own a stock that's super overbought, and here's one of ours, here's a stock that I talked about a year and a half ago, and people were like, who are these guys? Who is PTC, right? I was talking about them way back here. Why? Because of automation. One of the biggest automation companies in the world is in Milwaukee. I think their U.S. headquarters is here, which is Rockwell. PTC, kind of in that vein. Industrial automation. The stock's more than doubled, from where it was a couple of years ago. Coronavirus crash brought it back down. Now it's back up. Let's take a look at a weekly chart just so that lines make a little bit more sense. Now, this is also a stock that I told you this week I'd be selling covered calls on. Why? Well, it could rally all the way to 170-ish. I think that this is a legitimate target based on our interpretation of the technicals. And as it goes up, I just keep dragging this up to see, what is the actual top. Right now, it hasn't topped out. It's up again today. Today, I think, would be a great day to sell the covered calls on this that I mentioned in last night's article. So last night's article, there you go. These are 2 covered calls I suggested. Right, the 140 for around $7. Well, the stock's at 140 right now, so you'd probably get like $12 or $13. So if you wrote this covered call right now while you're listening, said, okay, well, I own PTC, and I know it's not a lot of you, but some of you do. If you wrote the 140 right now, take a look what the premium is. I bet it's over $12, 13, 14 maybe. So that means that you could sell at the money, and if it gets called away from you in March, you get a net selling price of like 153 for, depending on what the premium is. Now, you can hold on a little longer, but one of the things I will tell you is that from week to week, the market's kind of been flip-flopping, up week, down week, sometimes a couple of up weeks in a row, then a down week. We had a down week last week, up week this week. No, will we have an up week next week? We might. But I think from a risk management standpoint, there's a lot of charts that look like this right now. And the question you have to ask is, this wasn't that long ago. So does this represent the tax breaks and the easy money? And then this is just a setback because of the coronavirus. If you take from here, draw a trend line, from here to here, is that what should have happened? Maybe. I think it's easy to create yourself a chart with a curve. Oops, yeah, that's right. Gave me a curve. Connect this to this. You go, okay, what was the actual trend? You can use your charting tool to create a bit of a curve. Say, yeah, that looks about right. It's a little bit bent. These are some supports in here. So that curve makes some sense. Look at how it came right back down to that line again. Look at that. Hits the line and then starts moving along it. So that tells me that this curve makes some sense. Well, let's extend this curve then. Okay, so what's going to happen now that we're here? Is it going to go along this line? Is it going to bounce off of it? That happens all the time. Or is it destined to go here quickly, straight away? In which case, we probably want to move this here, right? And you can really do this with multiple points. Just making this easy. Hits the support, hits the support, hits the support, trends along the line, which tells us that this is probably about right. But where this ends up, is it this? Is that right? Is that right? That's the problem with technical analysis, is that kind of tells you where you've been and where you're going tomorrow. But some of these trend lines, who cares what they end up showing you, a year out? Is this going to trend along this line like it did here? Well, during this time frame, what's changing? Is automation accelerating? For sure. Is the market going to be as liquid? Almost certainly not. So from a risk management standpoint, when you have positions that have done this, and you can chart out, this is, kind of your range of outcomes. I can copy this, paste the curve back in here. Say, okay, what if I move the point to here, make this one here? This doesn't make a ton of sense. That makes more sense. So if the future is bright for PTC and the fibs are telling us that 170-ish could be a realistic target, 170-ish, is it going to go there straight away, or is it going to take some time to get there? If it's going to take time to get there, which is usually the case when there's reduction in liquidity, right? More time to get somewhere if there's less liquidity. Then what if it goes like this? It chops its way up there. In that situation, selling those covered calls against at least part of your position makes a ton of sense. And so would trimming and taking a little bit of profit here. So you have to figure out how much risk do you want to take, and then say, okay, what do I have to do mathematically to manage my money to reduce my risk to the level of risk I want to take? Now, you might be saying, to the moon. It's going to go here quickly. I'm not doing anything. Well, that means you're willing to take a lot of risk, because clearly it could come back down here. There's no doubt in my mind, this level here is in play right about there, right? That peak. And I don't know that I'd really be too interested in buying it unless it got under 100. So to me, this isn't the buy anymore. I think there's a lot of people who would be thinking the way I'm thinking, is that it's not really a buy anymore. And at this point, you're just trying to figure out, and PTC is just an example because there's a lot of charts that look like this, right? Early liquidity of the Trump administration, consolidation, coronavirus crash, massive liquidity again. This is all we're trying to decide on a lot of these charts is, when do they get to their top, and how do they get there, and how long does it take? In a lot of cases, they're already there. And the market's going to start thinking about, with this lower liquidity regime that's coming, with a slightly stronger dollar regime, most likely, what's going to happen. So I talk about this because I know that there's still people out there like, I want to buy. I'm telling you, that's fine, but you have to be extremely selective, because the okay stocks, right, the okay companies are going to start behaving and getting valued like okay companies and stock. And they're not going to be to the moon anymore. So two of the stocks that I'm very high on, we had these buy alerts a couple of weeks ago. One is one of the SPACs that I'm in, and on Monday, our Monday program is going to be all about SPACs. I mentioned that a little earlier. Half a dozen SPACs that I'm going to be buying up. One I'll probably buy today, and I'll mention it right now, although the buy alert won't go out until after I've done it, is Fast. I'm probably going to buy Fast because they just acquired Golden Nugget, 40% stake in Golden Nugget, and they folded the online gambling back in, which had previously been spun out just a couple months ago. I know because I've stayed at the Golden Nugget and I've bumped into some of the key management there. I think it was summer of 2018 or 19. When did I first tell you? Because I went to Vegas about a week before all my friends showed up, and I hung out at the Golden Nugget for a week. Made a lot of money playing poker there. And, hung out downtown because I hadn't hung out downtown since the 90s. It's been a long time since I've been downtown. That might have been 2000, the end of 2000, actually. The Golden Nugget is one of the gambling companies, and they own Landry's, McCormick's, a whole bunch of restaurants, like 600 restaurants. The guy who owns is the primary gentleman with Golden Nugget. He's also an owner of the Houston Rockets. So he's a big deal. Fritteri, I'd have to look it up again. I'm not looking at it, so I can't say it. The Fast, the symbol is FST, I believe, might be FAST. Take a look at that one. If you believe that everybody's going to run out and start to, do things again by later this year. What the market is missing, right? That's where you actually find value in a stock is what is the market missing when it values this company? And what they're missing here is the tremendous upside in the online gambling. So you've seen some of the other online gambling go through the roof. Penn, this can do the same thing. Because now that the technology is out there, and this is another SPAC is involved with this, is another SPAC that I'm looking at, is being able to manage your cryptocurrency, your reward programs, your regular currency, any type of point system that you're in. There's now a way to manage that all based on like a personal key, and you just do it right on an app. Well, that technology is out there now, so you're going to see all sorts of establishments adopt it so that you can have all of your points and all of your rewards and any Bitcoin you own, any foreign currencies that you own, all in one place. And you'll just have an app on your phone for that. So rather than having 17 apps, I got to look and see what I have at Caesars. I got to look and see what I have at MGM. I have to look and see what I have at the grocery store. I got to see what I have at the gas station. It'll all be there. One app. Bam, they're all in there. So go ahead and find that SPAC if you can. Otherwise, I'll write about it this weekend, and we'll talk about it on Monday. But some of these SPACs are real interesting because of the technology they're bringing to market. Other ones are very interesting because of the plays on technology and the rebound and the combination of the two things. Why do I like Fortress Capital acquisition? Well, what was one of the things we learned from Reddit is that Robinhood and even Interactive Brokers and TD Ameritrade had to slow down the trading in GameStop. Why? Because there's a 2-day settlement process. And the clearing firm in the middle of it required more capital in case the prices changed dramatically. Well, what did I say 2 weeks ago on this program when GameStop was about 400? I said that within a couple of weeks, it might have been last Friday, it might have been that fast. I said within a couple of weeks, what price did I say, what two price levels did I say GameStop would head down to? Do you remember? I tweeted one of them out. This is the chart I put out. I did say under 100, but I specifically said 80. Under 80 within a couple of weeks. It's 63 today. I said get in that $30 to $40 range. It got down to 49 yesterday. Now, how did I know that? Well, one, you could just tell, right? That's a stupid chart. But two, we had been flirting with this company way back here, right? 2017 and 18. So I understood the company, and here's what I can tell you about GameStop. And so the article I'm going to write is called GameStop After the Games. And at this point, right about here, GameStop in the 30s or 40s, you might want to buy it. Why? Because if they pull off what they're going to try to pull off, it'll head back up here, way over 100 again. Now I'll get up to 400 for a very long time. It depends on if they can become the Amazon of online gaming downloads. If they do what I said that they should do for 3 years now, which is close most of their stores and open up experience centers, right? They have a gift shop so that people can buy all the memorabilia that they also have. I mean, these places could be a big deal. If they have gaming inside, you have to have a membership to get in. You got to have your $19 membership, monthly membership, to be able to come in and play the games, to do the VR, to play in the leagues, to do the events. I mean, you're talking millions and millions and millions of people who sign up. And you're like, $19, well, I pay $19 for lots of things. I want to go to GameStop, play with my friends. Well, what about the guy who doesn't have a membership and their friends are like, hey, we're going to GameStop. Okay, I'll go. All right, well, you got to sign up when you get there. Okay. And I say, pull your credit card out, $19. It's going to happen if they do it right. So I'm not telling you to invest in GameStop if it gets down here. I'm just telling you what you need to think about to make that decision. Because if they execute, big if, then this could end up being a buying opportunity down here. We'll see. There's not enough information at this point to know if they're going to pull it off. But if they say they're going to do what I just said, which is what I think the Chewy guy is talking about, then they have a shot. So I want to give you, I talk about this not just because of the liquidity issues and the whole gamification of investing at this point for millennials, but how I think about these things, how I pick out the companies I want to be in. So when I say buy Fortress Capital Acquisition Corp, come full circle here, why is that? It's because they're going to get into fintech. This is a banking guy that's running this thing, right? It's not a shaman thing. It's a banking guy thing. Nuremberg. What's a solution that blockchain could have on clearing securities? Instead of taking 2 days to settle a stock transaction, blockchain can make it happen in a couple seconds, from 2 days to 2 seconds. Somebody's going to solve that problem. And there's all other sorts of problems in finance. The list is real long. I've been in this 30 years now. Financial industry has a lot of dinosaurs. When Jamie Dimon says the big banks should be afraid of all this change, he's telling you the same thing. So I own this SPAC, and it's a speculative investment, but because of the way SPACs work, I'll get most of my money back if they don't make an acquisition, or I decide I don't want to take part, right? There's very limited downside, but you've seen what some of the SPAC prices have done, right? They go up 20, 30, 40, 50% just with an announcement. Then once all the hurdles are cleared, sometimes they've doubled or tripled. Well, I want to own these while they still have the warrants embedded, and they're not really valued by the market. So these warrants become pretty valuable. So the SPACs I'm buying are specifically based on not only do I like the likely business opportunity or the announced business opportunity in the case of FAST and Golden Nugget, but the potential big problem that this could solve. And this is a big financial SPAC with the right guy running it. We just saw an example of a big problem that needs to be solved, and they have enough money to buy the right type of company, right? This isn't a tiny SPAC that won't be able to solve a big problem. They have the money to do it. So I like Fortress Capital Acquisition Corp. Like I said, worst case scenario, you lose 10 or 20%, but there's an awful lot of upside. Other company that I keep telling you to buy is Liberty Sirius. And, Warren Buffett, somebody accumulated a whole bunch of it when it got down to 40-ish. Liberty Sirius is going to acquire Sirius. At least it's going to incorporate the revenues onto their own balance sheet. Because when they get to 80% ownership, which is imminent, right, what they're allowed to do is consolidate all those cash flows in Liberty Sirius. The kicker with Liberty Sirius is it owns 30% of Live Nation. And when you back out the parts, you see that there's roughly a 30%, 20 to 30% net asset value discrepancy between the share price and what the assets are valued at, priced at in the market, You say, I'm getting a 20 to 30% discount to buy Liberty Sirius versus buying Sirius and Live Nation, which is what Liberty Sirius owns. Essentially, you're getting the slice of Live Nation for free. So somebody mentions Lucid Motors. It's a shit company. It's a lot of hype. So EVs are going to be dominated by the big players in Tesla. All these new little guys coming up, for the most part, they're all junk. There's just no way they're going to be able to catch up. So unless Lucid is something that everybody says, I got to buy one as soon as it comes out. No, I mean, they got that one. They got a couple pre-orders. They're not going to be that big of a deal. And the fact that the price goes straight up, it's a product of hype and liquidity. They're not going to be a hugely profitable company. How do I know that? Take a look at Tesla. Tesla's not a hugely profitable company. They make their money selling credits. How long do you think those credits are going to be around? Not much longer. Why? Because we know that the energy system is changing. So let's get back to where we started. We know that liquidity is coming down from the peak, and sometime in the next, however many months or quarters, we'll get back to probably not this level way down here, but it'll get close to normal. So what happens when liquidity is back to normal? It means the valuation matters again. So whether it's Lucid or anything else, they're going to have to show the market the money that they made. Can't live on hype forever. We know that. We know it's just a cycle. Can you trade around some of that stuff? For sure. Have at it. If you just want to be a trend follower, you don't need me for that. Learn how to technical trade and go ahead and day trade it. I don't day trade. Not my gig. I'm telling you what's going to be valuable tomorrow. And tomorrow will be in 6 months to a few years down the road. And if you take a look at what I've told you with Sun Power, when it was single digits, I said it might go to 100. Got halfway there so far. Or Enphase, when it was single digits, I said it might get to 60. It's way past that. They overshot. Enphase overshot. Now all of a sudden, Enphase has competition. But super fast growing market. So let's get down to one of the other things that Groman talked about this last week. And it was this. We'll talk about globalization at a different time. All right. Did Biden just establish a Green New Deal via executive action while everybody was screwing around with GameStop? I think maybe he did. The entire government has to start buying EVs now. Did you know that? Every government fleet vehicle in the next 4 years will be replaced with an EV. It's basically what it sounds like. Or they'll move in that direction quickly. If you read what's really going on behind the scenes, and the government, right, is a big mover of markets because they are a quarter of the money that gets spent in this country, give or take, and they affect even more because of the downline. Take a look at what they're doing. If you go through these executive orders, there's only one thing that you can come away with, and that's that the pace of change in the energy economy, which we talked about a month ago, was going to accelerate. What did Shamath say was the biggest change going to happen in the 20s? Change in the energy system. It took 40, 50 years for alternative energy to become whatever it is now, 14, 15, 16% mix. Now, most of that is, dams, hydro. When you take a look at just solar and wind, it's just a few percent, probably be 10% soon. I haven't looked at the EIA chart lately. What you're going to see by the end of this decade, and solar is outgrowing wind now 2 to 1, and probably 3 or 4 to 1 soon, is solar is going to become somewhere between 30 and 50% of the energy mix by the end of this decade. And because we're going to start using electric vehicles in the second half of this decade in mass, 2026 is the demarcation year. Why? Again, because of the mileage standards and the pollution standards. And you might even see as a part of this reconciliation bill, a carbon tax. I hope they just do a carbon tax. I hope they don't do energy carbon credit trading. All that does is make the hedge fund guys rich. Just put a carbon tax on it. That's all you have to do. And in that case, you're bringing revenue in. You don't even have to give many incentives, which is sending money out. And you're creating a bit of inflation, which is what you want. So if they tax carbon, which is going to happen eventually, what happens? You see an acceleration. I'm going to tell you right now, hear me now, believe me later if that's what it takes. Solar is going to be the #1 energy generation source in the world in roughly the next decade. it's going to pass everything else, everything. And then by sometime in the 2030s, it'll be more than everything else combined. That's how fast solar is growing, and the growth rate is rising. The rate of change is increasing from 20-ish% growth every year, give or take. And it's going to go up to 30 and 40 and 50. The growth rates in solar are through the roof and on the roof. If you have a warehouse, you're going to have solar. If you're building a new home, you're going to have solar. If you're a utility anywhere where it's sunny, you're going to have solar. And the grid system is going to change in such a way that transmission changes. I've been talking to you about that for a couple of years, and all the new technology coming in this, at the substation level, sun power and Enphase and Generac, Solar Edge, all these companies allowing you to switch back and forth between utility power and what you generate. At this point right now today, if you're building a house and don't put solar on it, you're kind of dumb. Now, I'm not saying you have to put a battery in yet because the batteries are still expensive. But why on earth wouldn't you put at least enough solar to power your house during the day? Maybe do one battery just to facilitate flow. Not saying that you should put enough solar on there to generate enough power for a week, enough batteries to store it. But a small solar system on every single house being built in America right now, it's what we should be doing because A, it's efficient, right? It's economical at this point. And B, it prepares you for whatever's coming in the future, which is probably much, much cheaper batteries. So all that's coming, and we will talk about it next week. So next week's presentation will be on the energy transition. Monday, we're going to talk about SPACs. I gave you a couple stocks that I think you should make sure that you own already today. I'll tell you, I have been backing off the ETFs short term because the ETFs, it's just, you really just need to be a stock picker at this point. You need to build yourself that 20 stock portfolio, even if it's 1% positions because you're waiting to get into the ETFs again. But the ETFs are just full of so many okay stocks. And ARK is full of so many hyped up, overvalued stocks. And yeah, a lot of those are great companies. You know, I told you about OnTrack, and then 2 weeks later, it's going through the roof and Kathy Wood's buying it. But I'll tell you this about ARK. I loved her a couple of years ago, 2-3 years ago. Now everybody else loves her. I can tell you this about money management. When you go from 1 billion to 10 billion, you're successful. When you go from 10 billion to 50 billion, you've got too much damn money to manage, especially if it's a focused portfolio. ARK Innovation was a 20 stock portfolio, and now it's a 50 stock portfolio. It's going to be hard for her to keep finding impact when the average position size has gone 5% to 2%, because she got so much money now that she moves the market herself. That's why giant mutual funds stop making money. She just got too damn big. And she's at that point right now. In my opinion, she probably should have sold that firm last month and started a new one, you know, called it Wood Investment. I think she's positioning herself to be bought by somebody like Invesco, though. We'll see. Because she's from that big environment, right? So if Invesco bought her out and said, you're the new president of the company, you know, she might do something like that. Or JP Morgan bought her or something. So she's holding out for a bigger check. I get it. But when she sells out, which can't be too far off, what does that tell you? It's like when private equity buys something and they take it private, and then 3 years later, they come out and sell it to the public for 3 times as much. You really want to buy that? Nah, you don't want to buy that. Somebody says, should we have a starter position in TAN? I told you buy TAN 2 years ago. I told you buy TAN in the spring, in last winter. No, none of the ETFs are priced right anymore. None of them. The ETF market is junk right now. You need a rotation away from the things you want to be able to get them. Liquidity should provide that opportunity at some point. If I had to guess, like I said, I'd say that we're in for a 2015-16 like period where we get lots and lots of rotation, lots of jitterbugging, but the absolute level of the market's not going to really be much higher in 2 years. Maybe it gets to 5,000 by 2024. That's what I've said on the S&P 500. But that doesn't mean it's going to happen real quick. There are way too many things out there. We got, 80 to 90% of the stocks above their 200-day moving average. That's insane. That's insanity. I've talked to you about the market being delusional, and more people just believe, well, that's just the way it is now. Nah, not if liquidity changes. And they're telling you it's going to change. And the big investors are already changing the way they invest. Been going on all year since June. Somebody's making a comment about utility scale solar costing half of what it costs to put it on an individual home. It's not that big of a difference, but there is an advantage of scale for sure. But then you have to do the transmission. It eats up a lot of the savings. The main takeaway here is that as we electrify transportation and industry, the transition is just going to keep accelerating until solar gets to somewhere between 30 and 50% of market share for electricity. And electricity use will go up pretty dramatically in the second half of this decade. So not only do you have solar taking market share, but the market will increase dramatically as transportation goes electric. That's in its infancy right now. That's first inning stuff. And then when we get to the seventh inning stretch and half of everything is solar and 80% of the cars being sold are EV, which will probably be around 2030, then those growth rates change and you have to apply a different valuation model. But for the next decade or so, the fastest growth out there is going to be everything in the energy transition. So I'm going to write my last peak oil report, peak oil plateau report, and we're going to switch the presentation, the working paper. I've been writing peak oil plateau reports since 2014, every other year. I didn't write one in 2020 because of what was going on with the pandemic. So the last one will be 2021, may be able to finish it this week. And then we'll start with, in the 2020s, the energy transition working paper. And we'll first introduce that next Friday. All right, have a great weekend. I am going to edit this down for you, get it posted later today. I strongly urge you, if you don't own Liberty Sirius right now, you're getting a company for 30% worth, 30% less than what it would break apart for today. They broke this company apart right now, you get 30% more. And if you think that a big SPAC in finance can maybe solve one of the big finance problems, I would make sure that you have this. And we're still trying to get MP materials. We talked about selling puts on this last week. So if you were following along this week, we looked at ways, we've been talking about AT&T, Kinder Morgan, Barrick Gold for a while. MP materials trying to get into Ford, keep expanding the position, Lumen Technologies. On the Ford front, and again, most of us have this position, so I don't mind talking about this in public. With Ford, the Google deal this week, and he finally made the statement that we're going EV. He said it this week. We're going to go 100% EV. Kind of tossed out 2030. They're going to have a bigger announcement on EVs than GM just had. Guaranteed. Then Lumen Technologies. No love for Lumen Technologies, but so I can talk about this one because nobody cares. Nobody's listening. Nobody wants a 7 or 8% dividend on a stock that, can double pretty quick. Why? Everybody's spoiled right now. This is a low risk opportunity with a fat dividend. Well, this one's Ford. That's Ford. Lumen could actually do better than double. It can make it to 40-ish pretty easy. It's 11. And you're collecting that 7, 8% dividend, whatever it is. Big fat dividend. And Exxon, what did I tell you about Exxon last year? 2 years ago, actually, 3 years ago. I don't know, when I started writing the negative Exxon articles. Exxon is down over, 50% since I started writing negative Exxon articles a few years ago. What did I tell you eventually will happen with Exxon? They either have to merge with Chevron or split up. Yeah, and it got down to almost $30 already, and it's still going to go under 30. What did we see in the news this last week or 2 weeks ago? Exxon approached Chevron about a merger, and Chevron told them to go pound sand. And now they're allowing an active investor in who's going to want to break up the company. If you actually learn about the companies that you're investing in, you figure these things out. You just start thinking like, okay, if I were the CEO or the CFO or the chairman, what would I be trying to accomplish? Now, I don't mean like most CEOs and CFOs and chairmen where you're just trying to maximize your stock options. But I mean like, if you were an actual owner of the business, what would you be doing with the idea that you wanted to pass it on to your kids? And every now and then, you get management that thinks like that. Exxon's has it for a very long time. Even Tilson was just a money grubber. He got in the company of a worse money grubber and it offended him. It's kind of rich. I get it, rich. In any case, Exxon's going to break up or merge or change the way it does business. But with all the frackers and Exxon and all these super in-debt fossil fuel companies, with this going on, just ask yourself a question. Very simple question. If 1 + 1 = 2 and their debt is 7, what's going to happen, right? Just got to multiply the barrels per year that they sell times the price, and that's going to tell you about how much money they can make. And then you take a look at the balance sheet and you go, they'd have to make that much money for 37 years, pay off that debt. And in most cases, that's about what it is. Exxon, most of the frackers, they'd have to make money, a lot of money in oil for decades to pay off their debt. And we know that's just not going to happen. So one question on gold. So Barrick Gold, I like right now because it's not in the S&P 500. Newmont, I like when the S&P 500 corrects a bit. You know where our buy zones are on those. The price of gold is eventually going to have a huge rally. I think it'll be tied to the regulation of Bitcoin and the realization that the recovery is going to take a while. There's not really a V. I don't know what letter. Muhammad El-Arian said like a swoosh, kind of gradually gets there until it's there. So think of the Nike swoosh and how it kind of curves. I think that makes some sense to me. Gold is a very well-controlled cartel market. Even though there's lots of producers, there's only so much gold. And the biggest producers control enough of the market that you're probably not going to see supply keep up with demand, especially given that there's gold needed for a lot of this electrification. Remember, biggest owner of gold in America. What company is it? What company owns the most gold in America? I've talked about this before. That's right, it's Apple. Why? Because those $1,200 cell phones, they got a little gold in them. So the silver is probably going to do well. And of course, Newmont and Barrick also do gold, do silver, a little bit of copper. Copper is going to be a big deal in this whole energy transition. That's why we've taken a look at Freeport-McMoRan. There are certain stocks out there that we want to buy and pull back. And there's a couple of ETFs that are getting close. I'll update that ETF, quarterly ETF file when we're closer. But everybody gets so anxious that, I'm not just going to let the horse run. I'll loosen up the reins when it's time to loosen up the reins or when we get close enough. Then you can decide whether you want to jump on or whether or not you want to kick the horse in the butt. Just don't use a whip. That's not nice. All right. Have a great weekend. I'm going to pick up the Hulk tomorrow and go visit Grandma. Pick up some Chinese food on the way. And then Sunday for the Super Bowl, I'm going to sit there and not watch the Packers because they won't be on because they gave the ball to Tom Brady and decided not to cover his receiver in the end zone. All right. Have a good weekend, everybody.